breaking news, a massive 500-point sell-off, dousing Wall Street in a sea of red, sending the Dow, the NASDAQ, and the S&P 500, all three, into correction mode. This is erasing all the gains for the year on all of the major averages. Stocks fell off a cliff right from the opening bell. They never looked back. We have special coverage throughout the hour, throughout the day, throughout the night here on Fox Business. Let's start with an all-star panel. Joining us now is John Thomas Financial's CEO, Tom Belesis, Steel Vine Investments Chief Investment Officer, Spencer Patton, and our stock editor, Liz McDonald. Good to have you all there. Liz McDonald, first to you. Now, we want to again advise, as our own Liz Claman was saying from the floor just moments ago, this doesn't have exactly the air of panic, but it's a 500-point sell-off. And the scariest thing to me was when we heard about these negative yields for treasuries and deposits. Now, I'm not going to get in the weeds, but basically what that means is that what's happening is banks are charging you to keep their money. When you have to pay people to keep your money, that's bad.
Yeah, and you're right, David. That did weigh palpably on the market. The news that Bank of New York Mellon is going to start charging customers, global multinationals and big investors a percentage point, for excess of deposits above 50 million. The problem there, and there's an important backstory for why this rocked the markets and caused a white-knuckled ride. When you have more basically depositors putting money with the banks, which is what we're seeing, a flight to safe haven status, the banks have to set aside more capital behind those deposits. That means less capital to lend, and that causes a miniature crunch in the markets. Less capital to lend means less job creation. So we're also seeing, weighing palpably on the market, J.P. Morgan Chase slashing gross domestic product growth rate estimates for the third quarter to 1.5%, down from 2.5%, a full percentage point down. Moody's also during the day coming out with the report that while the big nations will keep their AAA rating, meaning the UK, the US, France, and Germany, they're seeing still fiscal crisis and a test of political cohesion there and continued market turmoil as markets continue to lose patience in those countries.
Tom Belesis, are we now going to revert to that time a couple of years ago where your 401k statement arrived, you didn't even want to open it?
No, I don't think so, Liz. I mean, if you look at over the last 12 months, back last August, the Dow fell below 10,000. You had that 4 or 5 day sell-off back last year where the Dow came down almost 1,000 points. And if you looked at the valuations in the S&P earnings, they were rising. And if you have picked your spots back then and bought the correct stocks in the right sectors, looking 12 months after, you made a great score, for your investors. So I think we're in a time right now where valuations are becoming more attractive. You can't look at the
buying?
We're buying very aggressively right now.
What are you buying?
We're buying selective energy stocks. The sectors that have performed the best on a pullback, we are stepping in and buying the right companies in the right sectors.
But Spencer, is now the time to be buying when we may be on the verge of another recession?
I think that you really shouldn't, you should resist the urge of wanting to be a hero here. I think that it makes sense to start to buy in increments, maybe 1/8 to 1/4 of a position, because I think buying when the Dow is down 500 points has never been a wrong move when you look historically. But trying to call a bottom here would just be shameful, and I think it would be detrimental to your portfolio.
Doing?
So I think that you start buying quarter positions in stocks that have had really good earnings, like Nike, came out excellent earnings, Apple. Those companies are still going to do well and have shown that even during recessions they can maintain margins and maintain revenue. That's where I would want to have my money.
Okay, so that's where you would have your money. And Liz, people on this floor, the traders are talking a lot about Europe. It's sort of like somehow Silvio Berlusconi of Italy transmitted or somehow sent out this signal of extreme fear and panic. I don't know what happened, but people suddenly looked and said, if there was barely enough money for Greece, and that was like pulling teeth, is there enough for Spain and Italy? Yeah, and what did they do? This is a global issue. This is not necessarily a U.S. market issue. People globally, traders and investors, were selling off globally, not just here in the U.S.
Liz, that's a very important point because it's exactly what J.P. Morgan Chase has been telling me and talking to my guys over there. And also Bank of New York Mellon is saying that it was exactly what you're saying. They're saying Greece is still a big overhang in the markets. And you're right. And Liz, the real issue now is whether or not the markets, which are a leading indicator, are pricing in a recession, or is this forced trading also by computers via, you know, those split-second trades that they make down there on the markets? Is that causing the downdraft that we saw today, or is the market pricing in a possible double dip and, as you point out, another downturn, another leg down in the European Union?
Tom, is that what the market is telling us? Are they pricing in another recession?
I don't think so. I mean, you see overseas sales are surging. I mean, emerging economies are doing very, very well. I think ultimately, overall, if you look at corporate profits here in the U.S. with what's going on overseas, if you buy the right companies, in my opinion, you're going to do very well.
On Wednesday, we had 15 companies reported earnings. 11 of those 15 companies were positive, Tom. So, I mean, it is in contradiction to the corporate earnings. What's happening with these economic data?
That's a very good point, Dave. But overall, if you look at historically what's happened with the market and you go back last year, you know, we're in the summertime blues. People are taking profits off the table. We just came through a great quarterly earnings release. And you know what? People want to take chips off the table. Now, that's good to do. And advisors should suggest for people to take profits, wait for some pullback to get in at cheaper prices.
Okay, you know what, David, I've just been able to grab Doreen to find out more on what was driving the markets.
So joining me right here to talk about what happened today and, more important, what might happen tomorrow, Teddy Weisberg of Seaport Securities, Tom Belesis, he is founder and CEO of John Thomas Financial, Toby Smith of NBT Equities Research is in D.C., and Lee Hawkins of the Wall Street Journal joining us tonight from Philadelphia. Gentlemen, great to see. With a group like this, you don't have to worry about your money, folks. It's in good hands. Teddy, first to you. You've seen a lot of ups and downs. What's going on with the market?
Well, pretty ugly. I mean, they were just throwing them away today. Kind of, you can keep the cheese, let me out of the trap. I think investors, after last week's charade with this debt ceiling debacle, if you will, which sent such a negative message not only to everybody in this country but to the world. I mean, I think it exposed just this soft underbelly of this whole process. And we didn't really end up with a whole lot in the end. And then you had the GDP number on Friday and then the revised GDP numbers. So now everybody had to ratchet down their projections for the second half. And then the ISM number. I just think investors finally said, you know what, enough is enough. And they basically just said, you can keep the cheese and let me out of the trap.
Well, Toby, is the market overreacting here?
Well, David, it's not overreacting in the sense that, remember, we came off this huge bottom. I mean, by the way, I think Ted and I were here at the exact same time this time last year in the exact same situation. That's we're right at that same spot we were last year. Yeah. In this situation, you know, we got ahead of ourselves, David. We as a market, you know, was essentially driving on fumes, and it was looking for a reason to come down anyway. And boy, did it get a couple of reasons. I thoroughly agree with Teddy that the whole stink of last week's process took, a lot of optimism out. But these are corrections, David. In bull markets, you get these corrections. All of the major technicals are still in place. We had a lot of technical selling today because traders, not investors, were taking bets off. But I would actually look at gold right now, because if gold continues to come down because people have to sell, that's going to mean that we're still in a panic mode. And I think gold right now is the best indicator of where.
Well, let me give you an indication, because we have the gold futures right now. The gold futures at this moment are trading down about $11.40. Yeah. But Tom, to you, it doesn't really feel like a panic going on. Despite a 500-point loss, you don't get that panicky feel.
You don't. I mean, no one likes to see a 500 down day. Let's call it how it is. Unfortunately, we have a major issue in Washington. And Washington has clearly become the enemy of business. But put that on the side for a second. Last year at this time, we had the same media outburst where Greece is going to default. And Toby brought up some good points. The Dow was at a little under 10,000. Well, by November, Thanksgiving time, it ran to 11.4. If you positioned yourself accordingly, you had some nice returns for your investors. Now we're in a predicament where earnings just came out very well. Again, S&P earnings are rising, not falling.
Well, I like, Lee, the fact that we are not comparing this to 2008. We're comparing it to a year ago, because back in 2008, some people, I've gotten calls and emails from folks saying, oh, my God, it's just like it was back then. Back then, remember how over-leveraged many of the companies in America, I would say most of the companies, just like a lot of individuals were over-leveraged with debt and everything. All that, or at least most of that, has been cleared from the books. So we are running a much tighter ship right now in the economy than we were back then, right, Lee?
Well, in terms of corporate profits, we're seeing, even with General Motors, they have $40 billion in cash on their balance sheet, but that's also because they're very skittish about what's going on with the economy. We have to also look at, in past years when we've had this problem, last year the Fed was prepared to pump $2 trillion into the market. That's not probably going to happen again. And so really I think what's happened, David, is that we didn't have the fundamentals to really support the manufactured crisis that we saw in Washington. We had underlying numbers that were already poor, so our immune system was weak. As soon as we were exposed to the bacteria that Washington put out there, we got sick. And everybody, it wasn't a sell-off, it was a correction.
Gotcha.
People knew that the fundamentals were weak.
Lee, thank you very much. Before the market woke up and started selling off today, our next guest saw it coming.